But let's talk about what's really going on with the economy, especially given the spike up in crude, and how exactly does it translate into what one's investment style is going to be. Rupal Agarwal, Director Asia Quant Strategist at Bernstein, joins us on the show right now. Rupal, hi, morning. Great to have you on the show. Rupal, we often debate with most of our market experts, as in what is it that you should choose right now? Should it be growth? Should it be value? Considering that the two are, poles apart from each other, is there a midpoint, or has the time come now to take a decisive call on whether to chase growth or value stocks?
Hi, good morning. Actually, when we compare, value versus growth trade in India, we are somewhat still more, bullish towards the value part of the market. We are not expecting growth to lead the market this year. But I think within value as well, we only think there are only parts of value which we expect to do well, particularly, late cycle inflation hedges. Having said that, I think for us, the big call is, look at the defensive side of the market, which is either can be played through the high quality stocks or even the low volatility stocks. So for us, it's actually neither value nor growth. It's actually high quality and low vol, which we are recommending to our investors.
Sure. So what, according to you, Rupal, in the current market scenario, classifies and fits into the category that you just talked about, which is high quality, low volatility?
Sure. So I think high quality, low volatility in terms of sectors would be, sectors like healthcare, staples, technology. So these are some classic, defensive sectors in the market. But even big financial names would clearly appear in that portfolio. So we're staying away from poor quality, very deep cyclical financial names. But some of the bigger banks, will appear within that portfolio.
Hi, good morning. Can you elaborate a bit on that? Today's turning out to be a day of banks as well, right? Thanks just to all the regulatory news that's coming in, and HDFC Bank, which gets out of the curb list of the RBI, or Paytm, which is now entering. It's a very hot space.
Yeah, so I think, banks typically are, it's a sector which is, yes, a high growth sector, but at the same time, high quality sector tends to be a less, volatile sector when it comes to a market like India. And I think India financials is very different to how we typically treat financials in the world of style investing, right? Because generally financials is classified as a value sector, which is not really the case in India, I think. And that sort of makes the difference. When it comes to some of the, I would say the fintechs of the world, we are still classify that as the high growth side of the market. And I think the best way to play that new age growth companies, in our view, is one should look at valuations and the path to profitability as the two important yardsticks to look at that particular section in the market. So it needs to be linked to where we are in the valuation cycle. It needs to link to the fact that will that company continue to remain loss making for the next 2 to 3 years, or would the tide change? So that historically has always been two important metrics to judge the alpha opportunities within the growth segment in the market.
Now, Rupal, you've talked about cyclicals versus growth. Now, we're of course also talking at a time when you've got a geopolitical crisis of sorts that's on. Commodity prices are going through the roof. Inflation, whether it's transitory or structural, remains very high. That's going to, of course, impact corporate earnings, which has started to make such a strong comeback. What will be the strategy then going forward when earnings are going to be pressurized too?
Yeah, I think we've been actually calling for, positioning which is more suitable for an environment where the growth is actually slowing while inflationary pressures are still building. So, the fears of stagflation are actually coming to the forefront. This is something which is on the top of investors' mind. And if we look at from that perspective as well, again, it's sort of indicates that one needs to be more defensive, given where we are in the cycle. At the same time, some inflationary beneficiaries, like sectors like energy, materials will still give you some opportunities, but incrementally, one needs to be more on the defensive side of the market. So, sectors like staples, healthcare, which of course have not been doing well even when it comes to India, these could start getting some support. In fact, what we've seen is that January, a lot of the high quality pocket in the market was still seeing significant earnings downgrades, and that sentiment has shifted uh, quite dramatically in the month of February. We are now seeing high quality names being a net upgraded versus low quality names. So the sentiment support is clearly shifted. But at the same time, I would still say that the investor positioning has still been low, and we'll only start seeing that flow through, as we progress through this risk-off environment.
Now, defensive stocks, you guys have noticed, are moving positively with the US yields. Typically, when you have uncertainty the way we do, defensive is the way to play it. Is that what your folks' strategy would also be? IT, pharmaceuticals?
Absolutely. So, that's what I mentioned earlier as well. So, yes, the defensive side in the market, which is, your pharma, staples, tech, and big, financials are the ones to look out for. But at the same time, given that inflation is still a problem, and, inflationary pressures are likely to even move higher, at least in the shorter term, I think it's too soon to completely move out of the cyclical trade in the market. So, sectors like especially energy and materials, I think should feature in the portfolios still. We are not very positive on cyclicals like discretionary or, for example, industrials. I think these are sectors which historically have not really benefited during stagflationary time periods.
Now, how should one play, or is there any strategy for playing the inflation trade?
Yeah, I mean, so inflation is an interesting, macro, and it really has a very different impact on whether inflation is picking up broadly, say in India or in Asian markets, or inflation expectations are still moving higher, say in a market like US. So typically, what we see is when inflation expectations are still rising in US, your yields are still moving higher. That's usually a sign of growth. And hence a lot of it leads to a more risk-on rally in a market like India. You see a lot of your cyclicals, value tends to do much better. Smaller caps tend to do much better. But when we look at inflation becoming a problem regionally, that has historically always been more pro defensives. So your high quality, low vol kind of styles outperform, and your value, smaller caps underperform. So there is a contrasting historical evidence that we have. Where we are right now, I would say, we are still seeing inflation building up, so that we are moving into that more defensive risk-off environment versus say last year when US inflation expectations were still moving higher, but inflation was not really a problem in most of the Asian markets. So I think a lot has changed, and we've basically progressed through the entire cycle, and that's why we think that a lot of the cyclical trade, which has been very strong in India for the last 18 months or so, is broadly towards the end of its entire. I would say this rotation is broadly towards the end of the cycle. So only inflation hedges or late cycle plays within cyclicals, which can be actually expressed best through looking at companies which are generating high free cash flow yields. So that typically does well, during the time period that we are currently in. But incrementally, as I mentioned, start looking for opportunities within the defensive pockets.
Leaf out of what you mentioned, considering that the Asia Pac is so diverse and unique. I mean, I was just looking at data points. Taiwan, for instance, wherein the CPI stands at 27%, inflation has jumped up about almost 31% of late. India is a completely starkly different picture, and so is the case with each of the country. Um, how soon could India really snap out of this high inflationary scenario? And B, I don't know if it's pertinent to ask you or is it prudent to ask you, but what kind of central bank action are you expecting from the RBI to try and battle inflation at the same time maintaining growth?
Yeah, so I think that's actually not just specific to India. I would say that, that's a challenge that central banks globally are facing. The fact that inflation is becoming a problem, and how much, they are able to hike from here without, dampening the growth is going to be the most important challenge for central banks globally. And if we look at from an Asia perspective, you rightly mentioned a lot of the Asian economies are in a different stage of the inflation. And that's what we've seen. Some of the central banks have already started hiking the rates. In fact, from late last year. So, China is on a completely different trajectory of actually easing versus tightening. So, I think those kind of divergences are something which will continue. When it comes to, India, I think in the shorter term, inflation will continue to, become more of a challenge. We are still, more around the 6% range, which still is around RBI's target. But as we breach those target levels, given what's happening in the Russia-Ukraine, I think it will become more and more challenging for RBI to continue its easier monetary stance.
Sure. Rupal, great to chat with you today. Thank you so much for taking the time out and joining in.